Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.
Hi, everyone, and welcome to the RIA Edge podcast. I'm David Armstrong, the executive editor at wealthmanagement.com. This is, as you know, I think by now, my chance to sit down with decision makers of fast-growing RIA firms to try to understand their strategies around growth, how they approach growth, and how they're designing their firms in this day when, as we all know, RIAs are moving beyond solo practices and small practices and to larger professionally managed businesses and perhaps even enterprise level platforms. And I can't think of a better example of that trajectory than Merit Financial. And I'm speaking today with Kay Lynn Mayhue, the president of Merit Financial. Kay Lynn, thanks very much for joining us.
Well, David, thank you so much for having me. This is a topic that is near and dear to our hearts, so I can't wait to have a great conversation.
Well, I really appreciate it. And, I think the way to maybe start here, obviously, we know Merit Financial is aggressive, maybe is the word, acquirer of firms or active in the M&A marketplace anyway. But for folks who maybe aren't as familiar, do you want to just give a quick rundown of the 101 of Merit, where you guys are at now, number of states, AUM, so and so?
Absolutely. Yeah. So aggressive and growth. I think that's a good descriptor of Merit. So right now, I think we stand at about 24 billion of assets. That's around 20 billion or so of core assets and another 4-ish billion in that retirement plan space. We've got a total of, I think it's just over 50 offices. And next week, we're actually going to close on our 50th transaction. And so an interesting milestone. So I've been a part of around 48 of those transactions. And so we say that we have two different sides of growth that we're equally focused on. And so what we just talked about there was the non-organic growth on that partnership mentality. And we've got a couple different ways that we partner with advisors that I can't wait to get into. But we also have an equal focus on organic growth, because what I have observed in the industry, and maybe it's just business in general, if you don't have that organic growth story, it makes the non-organic growth either A, impossible because you're not going to attract the best people, or B, you're not going to get a lot out of that transaction, especially in a business like ours where you're actually depleting yourself if you're not growing.
Yeah, for sure. And I do want to talk about organic growth and how you think about that coming up in a bit, particularly spread across 50 acquired advisory firms, right? But we could speak about that in a minute. But first, let's talk about the M&A market just briefly, if you don't mind. I know you recently switched out capital partners. I think Constellation Wealth has become a new capital partner to Merit.
We did.
What do they bring to the table in terms of your growth trajectory or your strategy going forward?
Well, we are really excited about this new partnership, and speaking to what the initial relationship looks like and what they're bringing to the table. It's resources, relationships, and experience. On the resource side of things, they have arranged for a wonderful debt facility, a new debt facility. We were able to refi the debt that we had in play, and we just have so much dry powder under better terms to continue on the cash needs of M&A. Also, aligned in that same vein as on resources is things like technology. We're navigating some decision making on a few different pieces of technology right now. They are bringing not only intelligence on what's out there, but they're also bringing some great relationships on the negotiation side of things. And they're just frankly telling us to ask questions and think about the company, not where we are at this $24 billion, $25 billion place, but what does that $100 billion firm need? And let's start making those kind of decisions, because they have in their portfolio firms, they've got firms that are larger than Merit, and then they have ones that are smaller. And I would say the last thing that I think was a differentiator is their purposeful community that they bring together. So, for instance, I am in Chicago today for their CEO summit. And so we'll be sitting in a room talking about some of the same things that we're talking about today, David, on industry trends, challenges, opportunities, but really bringing that brain trust together. So that's just such an important piece of the relationship on that community.
Yeah, that's fantastic. We talk about the not just simply funding partners, but bringing that kind of deep expertise in the wealth management space, which and everyone can learn, right? Not everyone has all the answers, so I could see that being a benefit. Has the new capital partner in any way? Is there reading too much into it to suggest that it signifies a change in the trajectory, or perhaps the growth ambitions, or at least maybe the more tactically how you're approaching growth in the firm? In other words, are firms that you would now approach to acquire or partner with in the future going to change? Are they going to look a little bit different at this point of transition, or is it all the same?
Yeah, that's a really great question, and I think the new capital partner coming in isn't necessarily the catalyst for this change. I would say it's more around the evolution of where we are in our business cycle. And so will the type of M&A that we do change? If you look historically back at the 50 transactions we've done, I would say yes, in a couple different ways, in a couple different categories. So we have three ways that we partner with advisors and their teams. The first one is the easiest one to explain, and that's succession. So that's just someone that's not wanting to do what they're currently doing, either right now or in the future, or maybe there's some life circumstances that have led them down that path. Maybe they've got a great G2 talent in the advisor seat, but maybe that person is not in a position to take over that CEO entrepreneur hat. So we've got succession, then we've got leadership. So leadership is on the extreme other side of that. So that's someone that wants to come in and help us lead a geography, wants to help lead a division. We get really, really excited about those leadership ones. And then the third way I would say is somewhere in the middle. It's growth. So it's almost like that accidental business owner, advisor, or RIA that, because they've had so much success in new business development and growing, they found themselves having to deal with all of these complex issues, larger teams than they ever thought that they would be managing, technology demands and needs, and all of a sudden they're like, this is miserable. I hate this. Give me back to the part of business that I love, which may be sitting in that conference room with the prospect or out in the community, bringing in those next new clients. In all three of those categories, David, to go to your question around what is going to change, first off, the conversations that we're having right now with some of those leadership opportunities, I don't think in our life cycle that they would have been interested in Merit 5 years ago. We just weren't. We didn't have the scale. We didn't have the executive leadership team. We didn't have the technology build out. So I think that we are having conversations and are executing on partnerships of firms that are just they're larger, they're more sophisticated, and I think that is because of the evolution of the business cycle, not a direct Constellation coming in on our capital partner side. And then also, I would say the same thing's happening on the growth side. Those advisors that are just really interested in growing. For instance, we weren't in any of the custodial referral programs even a year ago. And so now we can check that box if that's something that they're excited about. And we've got a number of different organic growth tracks that our advisors can plug into. And all of those have been developed just in the last few years. So I think it's just it's going to continue to get better and better. And we're going to continue to have more and more offerings to enhance the client experience and to make that better for the advisors and their teams.
Do you find that the pool of potential partners that you encounter or that your team encounters as they're out there working on this has grown, or is it getting harder to meet that bar of, this is a good potential partner?
Well, I think it's probably because of things like what we're doing today. And David, frankly, what you all are doing in the media as far as bringing awareness to the idea of this whole concept. I hate the word sell, that whole sell and stay, because when you're truly plugging in as a growth partner or a leader, you're not selling, you're merging. The transaction has an equity swap and an exchange. You've got a lot of skin in the game that's going to grow as the firm grows, and you're wearing that jersey for the team. And so I think that when you look at where our pipeline is, it's more robust than it's ever been. We're having more conversations than we've ever had. But we're not having to convince people that they should consider this. We're getting inbound inquiries, or people are hiring a consultant or a banker to walk them through a process because there's this awareness around, for lack of better words, like it's working smarter versus harder. Like, can you get to where you want to go financially, impact-wise, with your clients, growing your client base? Can you do it smarter by partnering with a firm, or do you continue to work harder and just put your head down? So we're just not having to start with ground zero and convince people that they should consider it or have a conversation with us, because I think our industry has matured to a place where that is it's a viable option. And I think people that would have never considered it years ago are getting curious.
Switching to organic growth, because it strikes me that this is the key, right? Organic growth is what makes all these valuations possible, and
100%.
Why these firms are acquired or partnered with in the first place, and what they're looking for. How do you approach organic growth? You mentioned the custodial referral programs. That's one way. What do you think that a lot of the firms that you're partnering with are missing in terms of mechanics or just the tools of organic growth?
It is all across the board as far as on the organic growth. I'll give you an example, and I won't mention anybody by name, but if they listen to this, they'll know I'm talking about them. We brought in a sizable firm within the last few years that had, I think it was somewhere, I'll give you a range, it was like $600 to $800 million of assets under management. And we found out through that transition process of trying to communicate with their clients about what was going on with their partnership with Merit, that they had never sent out a mass email ever.
Wow.
Ever. And so it's just mind-blowing sometimes when you get into these very successful businesses that have done zero when you look at true concentrated effort around organic growth. And so when you bring that mindset, and this truly is Merit's mindset, where our responsibility as the firm is to put the appointments on the advisors' calendars. The majority of the advisors out there, their highest and best use is sitting in that conference room, meeting with that client, deepening the relationship and enhancing that the services that we're providing to that, not knocking on doors and kissing babies. And so we've really built a company that the philosophy around organic growth is that responsibility is at the company level. So how do you do that? You do it by building relationships. So yes, we mentioned the custodial referral program. We also have our professional alliance program, which is where we partner with other professionals. Give you a couple of examples, like P&C folks. We've got CPAs, where there's a revenue share arrangement where they are going to participate in those referrals that they send over to Merit and work in concert with that advisor. we've had offices that have been built from the ground up on those type of partnerships. Just one relationship with a CPA or one of those other professional alliances can lead to very, very meaningful organic growth. Partnering on the participant side, as far as working with the participants on the retirement plan side or on the ESOP side, and developing that relationship while they're employed with that company, or while they're an executive with that company. So you have that relationship when they do have a retirement or a job change, that you are the first one that they think of, or the only one that they think of along those lines. Banks, we've got a couple of really solid relationships with community banks where we are able to prevent them. I'll give you a great story. We have a local bank that we're working with in our Wisconsin area. And that local bank had a client that they knew was selling their business. So in all other world scenarios, they were going to be losing this relatively large, meaningful client that had had some loans with them and that they had had that business account with. So they referred that over to Merit through our partnership with them, and through that revenue share arrangement, they've actually monetized that relationship, and it's much more meaningful to the bank now. And that business owner is one of the biggest clients that we have received to year to date. And so it was a great thing for the bank. It was a great thing for the advisor. But when you have those type of institutional relationships, and it's not up to the advisor to go find that business owner, that's really what that building the RIA of the future. I think it's those of us that concentrate on it and figure it out. That's where this is going, because the unicorn of the generation when I got in the business back in the 90s, and people before me got into the business, those unicorns, they were the ones that were breakfast, lunch, dinner, cocktails out there in the community. They're willing to be up at the country club, hobnobbing with the people. What I'm finding is this next generation of advisors. They're fantastic advisors, really, really great advisors, but very, very few of them are great at new business development. And so if we can take that responsibility off of them and support them to where they can do what's in their unique ability and what fulfills them, the client's going to be better served and the business is going to grow quicker.
Yeah, you find this with younger advisors, right? The kind of reluctance to sell, for lack of a better word, right? Not as comfortable with that, the ask, which I understand. It's interesting, working with or even acquiring or partnering with however you want to, retirement plan advisors, something that you've done, I know. Is there plans to do more of that, maybe just for this purpose that you're talking about? We talk a lot about on our side all the time, the convergence, right? The convergence of retirement planning with wealth management, and how these are two coming together. You definitely see that out in the marketplace. And how is that informing your strategy going forward? Would we expect to see Merit partner with more retirement plan advisory firms?
Absolutely. Absolutely. So we're having a number of active conversations right now. I will say not all of the retirement plan advisors are equal, and that the RIAs that focus on the retirement plans, they're not equal. So we are highly selective around the ones that we want to entertain conversations with. When you look at it as an organic growth machine, you really need to look at the underlying companies of which those retirement plan advisors are working with. So if you've got someone that has a whole bunch of smaller plans, as an example, that may not be the best for conversions from participants to retail clients, because you might be looking at a very small number of actual folks when you dig in that would be qualified to sit down with one of our experienced advisors. So you're looking at plan size, you're looking at industry, you're looking at location. You're also looking at what has their relationship been. Have they been a vendor, or do they have a deep relationship with that company? Because there's quite a few retirement plan advisors, when you ask, like, when's the last time that you had breaking bread time with any of the executives or the decision makers at this firm, and they tell us never. Well, okay, the chances are not great of us having a really meaningful cross-selling opportunity on that. But when you find those retirement plan advisors that are relationship focused, that are truly adding value to those companies, but maybe just haven't figured out the secret sauce of providing that comprehensive relationship, whether it be offering things like employee benefits as well, or financial wellness, or that financial planning need, or the executive planning needs for those top level folks in the company. When you can find those, that's where it makes a whole lot of sense. But what we're not doing is just wanting to get billions and billions and billions of retirement plans underneath our belt. We really want it to be strategic.
Yeah, that makes sense. On the wealth management side, a lot of these advisors have kind of stumbled into retirement plan servicing because of a client who maybe owned a company and needed help with a retirement plan for their employees. And so all of a sudden the advisor is a retirement plan advisor as well.
Right.
Sometimes it works, sometimes it doesn't, right? I was once told you can't dabble in that world. You need to commit to it to make it work.
You have no idea how many people are dabbling in that world. And I think that that's actually one of the attractors on a few of the most recent conversations I can think of for that accidental retirement plan advisor or unintentional retirement plan advisor. And it's because we have that in-house. We have that team to take it over. We've got the back office. We even have retirement plan advisors to where if they want to hand over the entire plan, we've got them ready, willing, and able to do so. So I think that you're on to something there.
Talk to me about you're approaching obviously what we might call an enterprise level platform there at Merit, if not already there. The thing that we hear repeatedly in this space is the need for clients, right, to have this kind of personalization of service, but yet we want to do that at scale with a firm the size of Merit's or even larger. How do those two things coexist? Personalization and scale in a service business, those always seem to me to be at odds with each other. There might be a wider menu of options, but the personalized service seems to be something that doesn't always translate into the big enterprise level firm. How are you guys thinking about personalization at scale?
Two things come to mind when you talk through that. The first one is it's very different depending upon the companies that you dive into. And so what is their why? What is their motive? And we always say we're not building to sell. And so we're building to transform. And there are RIAs out there that are highly acquisitive that are building to sell. And I think when you see those, you see that very strict standardization. The advisors, in order for them to come in, really do have to leave some things on the shelf that could have made them successful in the first place because of that standardization for that scalability purpose. But you can't have it be the wild, wild west either. So I got some really great advice. It was actually one of my top clients. So I came into Merit in 2017 through a transaction myself. So I've literally sat in the shoes of thinking through like, hey, are we going to keep building, or do we want to see what else is out there around? If is it stronger together? And ultimately, what was best, in my opinion, for our clients and my team and myself at the time in that order really was that partnership. But when you look at the advice that I got, it was around guardrails. And I love that word that this client used when I was telling him about, hey, I'm thinking about merging in with Merit, and this is what the vision is, and what are your thoughts there? And he's a very successful CEO of a company that does a lot of acquisitions. And he said, look at it through the lens of guardrails. Why do guardrails exist? So they exist to keep you safe. Like if you think about the guardrails on the road, they're there so you don't go, flying off the side there. And his advice to me was make the guardrails as wide as you possibly can on everything, and then figure out what needs to be really, really, really tight in order for you to accomplish what you need to accomplish. So I'll give you a couple of examples, David. Technology. The guardrails need to be ridiculously tight on technology, in my opinion. We all need to be on the same CRM program. We need to be on the same trading platform. We need to have the same cybersecurity in place. So important. We can't have the wild, wild west on technology. So guardrails, super, super tight. Where are they wide? Investments. So we've got an amazing investment team. They run great strategies. Is it required that the advisors adopt those? No. I think it's a magnet, and it's the reason why the majority of the assets that we do manage are in those strategies, but we don't make it mandatory to where if there's something that's a secret sauce of the advisors that are coming in, we can figure out a way to work with them. The client financial planning experience. We have some minimal deliverables that we expect as a firm, but we've got advisors that love to go through the 300 pages of reports and use every little bell and whistle of every add-on financial planning software that they could possibly bring to the table. And then we have others that want to walk in with a balance sheet, a cash flow sheet, and a couple bullet points. And so that's fine on that minimal client deliverable, but we've made those guardrails really wide where we can. So I think that's where you were touching upon that, like individual client experience and advisor touch versus everything looking like the McDonald's, to where it's gotta be this way regardless of where you're walking into a location.
Right. Like the Starbucks model, right? Doesn't matter where you are, they all look the same.
Right.
The national firms, as I know Merit has ambitions to be, maybe benefit from a unified branding for the purpose of client referrals and client awareness and getting prospects in the door. You're not making any moves along those lines in terms of the guardrails, right? In terms of branding, these advisors are still free to do business in their communities as under their own names.
Actually, David, we've always been one brand.
Okay.
So this was something, and I know you all have written about a few of the larger ones going this direction. So it was really affirming to us. And I would say it's probably one of the most common conversations that we have. But once people start to see all of the advantages of that one brand, they start to become warmer to it. And then once they talk to folks that have gone through it, because ultimately, let's face it, this is a relationship-based business. Your clients don't care about the name on the door. They just don't. They want to know that the team that they've known and the people that they've come to trust are going to be the ones that are there when they walk in to the conference room, or they pick up the phone to call, or they join on a virtual Teams or Zoom call. That's what they want to know. And so this branding idea, and we've had some executives that have come from different firms that haven't adopted this. And it's fascinating to hear the complexities that happen when you don't have one brand. For instance, how many websites is the marketing team having to manage? How many DBAs is the compliance team having to wrangle up? How many ADVs are they having to review and update when there's some changes? And so I think that this one jersey, one team, one name has really served us well. And like I mentioned, when you see some of the big ones out there that weren't trending that direction, that all of a sudden are, it's just, it's been really affirming.
Yeah, I mean, it makes sense to me. I know that the wealth management space is a little bit different in that it's such a local game in terms of the advisor that folks know, and that's the person, and that's who you're going to go see, and we recognize the name on the on the whatever might be the event or anything. But it makes sense. I mean, the one branding, it makes sense. Speaking of these guardrails, the other thing I'm kind of interested in is how you think about efficiency, advisor efficiency. 50 some firms out there, and I'm sure, they all have slightly different shades and nuance. Is there and I appreciate the fact that you're not handing them a template and saying, you must look like this. You must have this many clients for this many advisors or this much, blah, blah, blah. Nonetheless, as a business, right, you want to make sure that these are efficiently run operations. What kind of metrics do you look at in terms of advisor efficiency to think about, okay, this firm maybe is like a little bit heavy in support staff, or maybe too lean in support staff, or, how do you think about evening out that kind of organizational structure to make it the most efficient you can for the business? That's a big question, I know. I'm sorry.
It is. And it's been an evolution as we look at, so I personally, and I'm figuring out that I'm more of this than I actually thought I was. I'm a data-driven leader. So people ask me questions or they'll make a suggestion, and the majority of the time I'm going to ask for something behind there, or I'm going to ask for some information to either confirm my thinking, or if I have a blank slate, to help me formulate that. And so we own our own data, which I think is really important at certain levels in the business, because once you own your own data, and so we've got our data warehouse, you can massage it any which way you can think about. And so in that example that you gave as far as support staff, there's so many variables. So we have some of our offices, for example, that are higher net worth clientele. And then we've got others that are mass affluent. You really can't look at an AUM number or even a revenue number and make an estimate on the number of support staff that would be needed to support that, because an ultra high net worth or high net worth client base is going to need different support. And so they may need to have financial planners, as an example, that are in that office. They may need to have that diamond service team where there's multiple people in that advisor role that are serving that same client. And then you take that and you look at it on a mass affluent client base, and that would be overkill and would be completely inefficient to have some of those same resources when you can just use the centralized financial planning resources. And does it make sense to have multiple people sitting in a conference room with a client that may not have demands that sophistication, or revenue wise, it just financially doesn't make sense. It wouldn't make that client profitable. So what we have found is breaking that down into the average client relationship is very important. Also, you have to look at the underlying advisor and the growth that they have. So for our growing advisors, the ones that are just knocking it out of the park, what we want to do is surround them with as much support so they don't cap out, that we can keep their capacity growing. And so we may be overstaffing an advisor by any of the metrics, but it's because they have an insatiable appetite for growth and they're showing us that they have the ability to get those results. We've got our circle of excellence, which is our top advisors that we have a fun trip that they get to go on, and some fun recognition that comes with that. But what also comes with that is going to be over support, because we want them to continue to be in that beat where they've got capacity and energy to throw into those new client relationships. So I know that was a long-winded answer, but I think my bottom line answer would be get to a place where you've got the data that you want in order to make those kind of calls on, is this efficient? Is this overkill? I could also share a funny story. There was an office that was telling us they needed more and more and more people. And when we had a new technology leader come in, the first thing that Brian did is he looked at technology adoption. And what we figured out is this particular office was the worst one when it came to adoption of workflows, when it came to the adoption of a couple of the AI focused technologies that we had. And we're like, aha, here's our problem. it's not a people problem. It's a policy and adoption and maybe some training. So do we have the right people, and have we equipped them with the right training to be very efficient in their jobs?
It's interesting. Yeah, I mean, we talk to advisory firms, and there will be some that will say, well, we know that it's time to put it in capacity when the advisors reach capacity. Then we know we need to hire some support. Other firms like yours, it sounds like, you're identifying those growing advisors and saying, we're going to, lead the capacity always like a little bit ahead of the advisor's growth curve, right? So there's always going to be some space there. So on paper, it might not look like the most efficient advisor in the world, but because of that growth trajectory, you've already built in the capacity that will allow them to continue. That's interesting.
Well said.
I know I'm pushing up against the time here. I'm sorry. Just as a leader of this organization, maybe you could just let us know, what is it that keeps you up at night? What worries you? What or maybe conversely, what is most exciting for you about the future of Merit?
Yeah. So what keeps me up at night? I would say, in a good way, what keeps me up at night is our team, our leadership team, and our advisors, and making sure, because I take this very personally as far as a responsibility. I mean, you think about it, we've had 50 firms say, yes, I see the vision. I am coming with you. I'm putting on your jersey, and making sure that we are making decisions through that servant leadership, that mindset around we exist to fulfill what they want us to fulfill from a leadership team. And so that requires opportunity, that requires things like us just going through this recap process, making sure that we've got the right capital needs, that we've got the right debt needs, that we're attracting the right leadership team. And so I think that when I have looping thoughts, it's around that organization that we're building now for the future, to make sure that we're going to be able to check the box on reaching and impacting all of the lives, and not only keeping those promises that we've met, but exceeding those. And so that's definitely something that we have a lot of conversation around. What am I the most excited about? It's also the same answer. It's the leadership team. I was just talking to Rick Kent, our CEO, and we were rewinding where we were 5 years ago, and there was so much key person risk, and we would be sitting around talking about, like, who's going to take this, and it would be Rick or I. And now, over the last few years, we just had our leadership summit last weekend, and it was amazing to look around the room at these very, very high qualified, experienced individuals that we've been able to attract. Everything from our just incredible COO to one of the best, if not the best, CIOs in the business, on the technology side, our chief growth officer, just so much potential. And all of these people have joined us not because of where we are now, but where we're going. And so I'm the most excited about our team.
Well, that's fantastic. Thanks very much for joining me. Any final thoughts before we sign off here?
Yeah, so I'll just expand upon that last comment around what I'm the most excited about as far as from a team standpoint, and challenge everyone that's listening to this. We waited way too long on a couple of the strategic hires that we did, and I think that our team suffered because of it, and our client experience for that time period had suffered. So really trying to stay, especially if you're a fast-growing company, trying to stay ahead of those needs. So don't just get caught up in the numbers, and if you're doing acquisitions, the acquisitions that you're doing, really think about what those leadership team needs are going to be, and hire that, attract that, bring that in earlier, much earlier than you think. If I could rewind the clock, that is one of the major things that I would have done differently.
Fantastic. That's great advice. Kay Lynn, thanks very much for joining us here on the RIA Edge podcast. I appreciate it.
Thank you so much for having me, David.
And thank you for listening.
Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.